Let's get across the market open on this Monday. Mark Gardner joining us from MPC Markets. Mark, happy Monday to you. Let's start first what we saw on Friday. There was obviously that focus on that core PCE data out of the States, pretty much in line.
Yeah, it was in line. It was up 0.2 at 2.9. There was more than usual concern over that number. The GDP numbers come out in advance, preliminary and final, and there's not usually much movement in the final GDP numbers generally. But we saw a 0.6 upward revision for the GDP number to 3.8. So people were actually a little bit concerned about there being an upward revision in the PCE numbers. So coming in as an expectation, I mean, it's still around that 2.9 mark, which is a lot closer to 3 than it is to 2. But we did have Michelle Bowman, who is the vice chair of the Fed at the moment, basically reinforce that there were rate cuts coming. Which was kind of a little bit in conflict to what Powell said earlier in the week. But we've got a raft of Fed speakers this week.
She's particularly dovish, isn't she?
She is particularly dovish and probably lobbying for the job, I would say. So she would be talking, she'd be thinking about next May. But overall, we will have a bunch of other Fed speakers this week. I think there's 6 or 7 that'll come out over the following days. But this all really hinges on payrolls, which is this Friday night, and they're expecting up 50,000 and 4.3. But any weakness in the labour market is more of a forward-looking indicator rather than GDP being very much a backward-looking indicator. So, if they get a weak number there, then it'll be rate cuts back on the table.
Meanwhile, locally, it's a bit of a different story that's panning out here. Obviously, the RBA meeting tomorrow, expectations they will remain on hold, but more of those cuts actually been priced out of the market at the moment.
Yeah, they have, and we've got inflation numbers sort of stalling that as well. So, I don't know whether you would call a weakening labour market for low 4% unemployment rate. I think that's around about perfect employment in most economics books. But so I think the RBA will remain on hold. But there are signs that the economy is weakening a little bit, both here and abroad. And I think we'll eventually get those cuts. It'll just be the timing of those cuts. So I'd be more so interested in the press conference afterwards than the actual announcement. But I don't think it makes a major difference to the broad equity market as long as we get the cuts that we're expecting over a course of time. It really makes no difference. I think trying to time it, that's the job of bond traders and short-term interest rate traders. But apart from that, the equity market shouldn't make a lot of difference as long as the cycle goes as expected.
Are you expecting, though, the Australian market is going to continue to underperform the States? I mean, obviously, Wall Street very much driven by that AI trade. That's a less opportunity here. It's more commodities that we're focused on.
Yeah, commodities we're focused on here, but I mean, you've got precious metals having a fairly serious rally here at the moment. Iron ore's been knocking on the door of sort of 6-month highs as well. There's green shoots in that Chinese economy and property markets. So we could start to see commodities start to head a little bit higher broadly. And look, I think you've got 10%, the top 10% market cap of the US is now something like 75% of the total indexes. So, and you have, I think officially there's about 5 or 6 major indicators that are regarded as valuation indicators from investing legends like Buffett, etc. That are now, the average of those is now saying it is the most expensive market in history. It's outpacing 1929. It's outpacing the .com. It's outpacing the GFC. With that concentration risk comes downside concentration risk as well. I think the easiest trade on the board is definitely those gold miners, the silver and platinum plays that you can possibly do. Because they're definitely heading higher, and we did have issues with Ukraine and Russia over the weekend. I believe there was 600 drones, 50 missiles, 4 dead, 70 injured in Kiev and other cities in the Ukraine. So that is starting to heat up. Poland scrambled jets. So I think that defence play and the precious metal play is still a fairly decent, and safe play in the market overall.
Okay, so obviously focused on gold still. What about those other precious metals such as silver, which has played catch up?
Yeah, it has played catch up. I think we're around about 8 to 10% away from the record high in 2011 there. But look, the 50-year average of the gold-silver ratio, with gold at 3,800, which it is here at the moment, there's still about 37% to go to even just get back to that 50-year average. You've got most of the nations who produce silver are BRICS nations, which Trump's very much at odds at the moment. And as you can see back there in 2011, when silver gets on a run, it gets on a pretty heavy run. So, and platinum in particular as well, the 50-year average for platinum and the gold to platinum ratio is 1-to-1. And we're talking $1,500 for platinum at the moment. So I just went to the 25-year average, and you've still got about 85% to go, just to go back to the 25-year average of platinum to gold. So gold's really led the way. We're not in gold price anymore, we're in gold miners, because gold prices being up here will extrapolate out into the gold miners having more EPS growth than the gold price can possibly deliver, and we've seen that GDX has outperformed in the last month, particularly by double. Silver, I think you've got a couple of junior miner choices here in polymetals and in silver, which we have at the moment, or you can do the ETF. But the platinum, you've really got no choices because South Africa and Russia take up 90% of the producing in the world there. So the ETP MPT is probably your best bet just for physically warehoused platinum, because I think that that'll start to go on a considerable run as well. And both silver and platinum have some serious industrial uses these days for the semiconductors as well.
And Mark, when you talk about you're in the gold miners, are you still in the big producers, or have you looked further down the scale?
Our Alpha, which Jonathan Takadina runs, is more in the junior miners. We've had the likes of Golden Horse and a couple of other smaller names. We've got Northern Star on the big end of town. We have had Newmont on in the past, but interestingly, Newmont and BHP are in the top 5 silver producers in the world as well. So there's a lot of tailwinds at the moment from not only copper, but potentially uranium, silver, and whilst iron ore is 50% of BHP's profits, if we see significant jumps in silver, we see significant jumps in copper and uranium prices, I think you'll start to see BHP really pick up, because that 50% may be reduced because they're getting much higher margins in those fringe commodities, which have been at pretty horrible lows in terms of commodities over the last couple of years. So I would say BHP, if these prices continue to rally, BHP's next earnings season will see some heavily increased margins in some of those fringe metals that people wouldn't be expecting.